Thanks for tuning in, guys. So today we're going to be just walking through the numbers, and then we'll kind of talk about what we think about it in the end. Yes, so there is an announcement that there's a 50-year mortgage. It's basically approved. It's only through Fannie and Freddie Mae for right now, which means conventional. VA is not on that train rag or on that train yet. I think the only thing they're mainly focused on right now is or the next thing they're going to be focused on is trying to figure out, how they're going to make this permanent variance in regards to buyer's agent commission. Um, VA clients being able to pay for buyer's agent commission is still a temporary variance since the whole NAR thing. And I should probably do another training about this, but basically nothing's changed. If anything, I just allow clients to be able to pay for commissions to give them more of a competitive opportunity, not an edge, but an opportunity. But for the most part, VA loans are still done the same way. There's no 50-year VA mortgage yet. But we're going to go into the math of how this all works out. So, why did it become a thing, this whole 50-year mortgage? So, am I sharing my screen? You guys see my?
Yeah, you're good.
Okay, cool. Thank you. So why a longer mortgage exist? Keep in mind this is only for conventional and Freddie Mac and Fannie Mae. So home prices are increasing. We can't really talk about that. If you guys have been part of my VA house hacker program, we talked about why home prices are only going to get higher over the next, and we show why as far as birth rates and things like that. So home prices are going to continue to go up, and there's still a level of appreciation. I think I did some crazy interesting numbers the other day, but basically, if you bought a house in 2019, I learned that if you bought a 400,000 house in 2019, by today, your house would be worth $600,000. And from if you add up the yearly appreciation from 2019 to now, the average appreciation over since 2019 would have been down about 9%, which is crazy numbers because in 2021 and 22, we were seeing like 12, 15% appreciation yearly for those years. So, it's a good and bad thing that home prices have slowed down because we need everything else to catch up. Wages, rates getting lower, things like that. So we're in this double whammy where home prices are higher and also interest rates are higher. So that's causing a little bit a squeeze on the buyer market. But the tough thing is that we're even in a market where there's not enough buyers, we still are in a very low inventory situation nationally. So the idea of this 50-year mortgage coming in was to basically lower monthly payments to improve affordability. But one of the things that we got to talk about is the long-term costs also increases significantly. So let's just kind of give a in the military, we used to like to say we need to set initial conditions before we explain anything. So here are the initial conditions. We have a $450,000 mortgage. This could be a $500,000 house, whatever it is, but the loan you have is for 450. Okay. Let's assume a 5.5 interest rate. Rates, and the reason why I chose 5.5, this is slightly above average. Average rate, if you average all the rates in the last, I don't know, 30, 40 years, we would be seeing around 4.5 to 5.5%. So I chose, kind of the higher band. So 5.5 is pretty average. Let's say you bought this year in Kitsap County, which so everyone in this meeting is from Washington State. So getting right into it, what is the monthly payment comparison? So on a 50-year mortgage, compared to a 30-year mortgage, it's about $350 difference for a 50-year mortgage versus 30. How are you feel about that number compared to 50 to 30? It's really not that much if you really think about it. $350 just to extend another 20 years, really not that much. And this probably scales up and down as you go up and lower in purchase price. It's not that big of a change. I chose 450 because that's slightly below average. Well, I would say probably in the middle or below average for Kitsap County. So it probably doesn't, but it scales pretty well probably as you go up higher in purchase price, maybe a few $100. Not enough really to make it a swing. I mean, $350 to give you guys a perspective is most people's credit card payments. So like I'd say a $10,000 credit card to around there is about a $350 payment or about I don't know, maybe like a $20,000 car loan, I would say. So That's one perspective of how to give it that $350 a more of a comparison. Now, if we look at the total cost over the life of the loan, that's another thing to consider. So, 30 year on a $450,000 mortgage, you're paying about $470,000 of interest. Between principal and interest, you're making about $920,000 worth of payments. If you compare that to a 50-year mortgage, the amount of interest that you're paying alone is almost the same amount of payments between interest and principal on a 30-year mortgage. So, not far off. And then the total payments between principal and interest is about a little over $1.3 million dollars. So, basically, the amount of interest you pay is double for an extra 20 years. And then you're making another $400,000 worth of payments between principal and interest. So kind of gives you a perspective on what another 20 years. And this assumes they do the mortgage math the same way. Okay, I want to be very, very clear about that. I'm assuming they're doing the math the same way. They haven't said they do the math different. So I want to make sure that's clear. But yeah, if we do the same math as they do with the 15, the 10, the 20, the 25, the 30-year mortgage, as far as the amortization, and how principal and interest is figured out, if they do the same thing with 50-year, that's basically what it looks like. So that gives you a perspective on what an extra 20 years does, which is kind of wild to me. It's only an extra 20 years, but it also is basically double the amount of interest you pay already. So that's kind of nuts to me. Um, Now, the amortization speed. So one of the things that we talk about in my in my house hacker program is about the half-life of the loan. So what the half-life of the loan to me, and this is something I just say because this is when your principal and your interest payment in your mortgage are the same. So in your monthly mortgage payment, you have principal and interest. Generally, for most 99% of mortgages that you get into, you're going to pay more interest in the first half of the loan, typically on a 30-year loan. But then it gets to a point where your principal and your interest portions in your monthly payment become the same. And then the next payment is when principal becomes more than interest. To me, that's when they become the same. I coined that as the half-life of the loan as a guy who's from the nuclear field. So on a 30-year mortgage, typically it's about halfway through the loan, a little more than halfway depending on the rate, but it's about around the 200, it can be between the 180th to the 220th payment, which is halfway through the loan. So for a 450,000 loan based on, the 5.5% rate, the half-life mark is about the 209th payment, which is about 58% of completing of paying off your loan. And that balance is about 278 from 450. So about $122,000 of principal payment is when you'll reach the half-life mark. The 50 years about the same, but it takes about 449 payments to get to that half-life mark on a 50-year mortgage, and you're about 75% complete paying down the 75 percent of the loan. So out of 600 payments on a 50-year loan, you have to get about to 449th, the 449th payment in order to reach the half-life mark. And that's what, and if you took the same loan amount and you adjusted the rate, like maybe you bring down the rate, that half-life mark gets happens sooner and sooner and sooner. So that's what a lot of people don't know about refinances is that half-life mark changes. But that's a really big detail because it takes another 240 payments to get to the half-life mark on the 50-year mortgage compared to the 30-year. So, which means this is what this means at the end of the day. It has to do with equity, because how fast you pay down the principal. And a 30-year mortgage is going to be much faster after 7 years than it would be on a 50-year. So if you look at after 7 years, this is equity after 7 years. The value would be about, let's say it's 4% yearly appreciation. Over 7 years, your house should be worth about 592. On a 50-year mortgage, the amount of equity you have is about 156, right? 157. Most of it is gained by appreciation, not mortgage paydown. So that amortization gained, that's if you were to make the normal payment, that's how much you would pay down the principal, only about a little under $15,000 of mortgage paydown. On a 30-year loan, it's about 192. The appreciation is the same, but you actually pay, almost, what was it? It's 4 times more principal pay down than you would on a 50-year. So you notice on a 30-year, as you make your payment after 7 years, you would have paid down $50,000 on the loan itself. On a 50-year, you're only paying a little less than 15K. So there's your a really good comparison of like if most people sell their house around the 5 to 7 year mark. Okay, maybe seven. I would say seven. It's usually the average is about 7 to 10 year, depending how rates are. But 7 to 10 year mark is a kind of like an average of how long most people keep their homes. So why this is important is because after 7 years, you can tell the difference between $40,000. It's the difference of $40,000 on the equity that they may have, depending on the loan they're in. So that's something to consider when you're thinking about um, what a 50-year versus 30-year does. Again, this is all based on, this is all still based on Kitsap County as well. So that's kind of a big deal over the timeline, especially if you're trying to build equity in this game plan. Again, we don't have 50-year VA mortgages yet, so this may not apply to VA yet, but just something to consider. The math is going to be roughly the same. The rate might be slightly better, but still, it scales, right? So, appreciation is still identical between the loans, right? But the difference comes from how fast they pay down their loans. So it's about 3.5%. You build 3.5% more. You pay down your principal 3.5% more over year by year on a 7 year after year seven. So that gives you an idea of like why you may or may not want to go to a 30-year versus 50-year, depending on the situation. So. As far as wealth impacts, 30 year will be the probably the fat. Obviously, as you go down in the amount of years you are in the loan, you're going to build equity faster, but most people are in the 30 year just because that payment's a little bit easier. Um, but to give you guys a perspective, a 15-year mortgage versus a 30-year mortgage, the payment on a 15-year mortgage is about 50% more on the payment than a 30-year. And a 50-year is only $300 less than the 30-year in this situation. So it gets to a point where it almost doesn't make sense. It kind of makes me wonder why didn't they just do a 45-year and just kind of kept that 15-year increments. So that's kind of a weird, interesting feature is that the 15-year to 30 it goes down by a decent amount, almost by 50%. But 30-year to 50-year is not much of a change at all, like only a few $100. Now 50-year, again, lowest payment obviously, but extremely slow amortization. So you're really not building a whole lot of appreciation after even after 7 years. Now that's what's tough with VA clients is that, if they do a 50-year VA mortgage, 50-year almost makes no sense. Because generally those clients are in that house for 3 to 4 years at a time because of moving, military moves, things like that. So a 50-year most likely will not make sense, even if it saves them $350 because of how much equity they're going to have after 3 or 4 years. So, and then the other thing to note is that if, depending on their certain aspects about their VA loan, they will most likely be underwater on the house when they first buy it. So if you're considering the VA funding fee, which makes their loan amount slightly higher than the purchase price, putting them in a 50-year mortgage may only get them to pay off the VA funding fee after 7 years, when they may need to sell the house in 3 to 4. So something to consider with VA clients. I don't think the 50-year is a good loan program for active duty VA clients. Maybe VA clients that are going to be in the area for at least 7 years, at least. But because that's the only way to really start making money because they're not going to have that much mortgage appreciation or mortgage pay down. They're going to have more appreciation. So that's kind of the thing there. When it comes to trying to figure out what makes sense for the 30-year versus 50-year. I guess, you could consider like it's a short-term hold. You try and keep the payments low, try and put as little as money as possible. Um, Maybe, I don't know about renting. I don't know if that would be a good idea in the idea of that for $350 a month. Maybe that has to be a super long-term hold, I guess. Um, But yeah, even if you have someone else paying your mortgage, it would just be banking on appreciation. You would have to probably hold that property for at least, yeah, at least 7 to 10 years at a minimum, even if it's a rental. 30 years, that's what's I think 30 years a nice is like I don't know why how they got that math to do what it did, but at 30 years, the way the payment's structured, even after like 5 or 7 years you've built enough equity, you've paid down a decent amount of the principal, you should have a decent amount of equity to be able to cash out on the equity and then also be able to have a balance of be able to profit on the rental income depending on where you rent out the house or what state you rent out the house. So but basically, yeah, the 50 year saves $350 a month, but costs $400,000 more in or interest in this scenario. But you lose about 36K in equity versus a 30 year after 7 years. So, in conclusion, I don't know. Based on the numbers, 50 years, meh, not, I don't know. I think I think they did it just to kind of appease the public since they probably don't understand this math or they never really understood this math. I think a lot of people are getting a sense that yes, it's going to be a hell of a lot more interest when they pay it. But I don't think they understand the other pieces of the math that go down the line as far as equity building, as far as how much interest they're paying, as far as how fast they're going to be paying down their mortgage. If they're not considering those things, they're going to see the 50-year mortgage as a as a I don't know it's not going to solve any problems. Let's just say that. It's not going to, it's almost, you might as well just rent. I'll be honest, like you're not going to build that much equity. If anything, you might, I guess it's still building a house, but you still got to be in the house for a long time for it to make sense. Yeah, I think that's the weird thing about this 50-year mortgage is that there's really, I don't know. I'd say if you can't afford a 30-year mortgage, because it's only a few $100s more, maybe it's not a good time to buy a house. And maybe you could refinance into the 30 year when things are a lot better, to get it better. And then maybe cash out refinance, stuff like that. I could see that happening where they get into the 50 year as a means to just to get in. And then refinance later down the line when finances are a little bit better. Then you can refinance to a 30 year. I wouldn't go any less than a 30 year on a refinance. Um, Maybe that would be the strategy to do it. But man, I'd say if you can't on a 450,000 house and if you can't afford an extra $350 a month, then you have a lot bigger problems, I think, financially. But it depends on the situation for sure. So, um, but yeah, that's basically the end of the presentation. Do you guys have any thoughts, questions, discussions, anything like that?
Just a few dumb questions.
What's
Um,
up?
so I guess like realistically speaking, if you assume, this becomes more widespread, like available, like what would the situation have to be for you to see yourself like recommending a 50-year mortgage to someone?
It's almost the same response as when they were trying to market the temporary buy down. Are
Put my
you
camera up so you can see me.
do you know what that is?
No.
Okay, so temporary buy down effectively is you're buying down your rate temporarily, and it's there's like for example, it's a 2-1 temporary buy down. So
Uh-huh.
for example, let's say the market rate's about 6.5%.
Okay.
If a client decides to do a 2-1 temporary buy down, the first 12 months of payments is 2% less than 6.5. And then on year two, the 13 month to the 24th month, it's 1% less than the 6.5 rate.
Okay.
So that's a temporary buy down. And you're only buying your rate down temporarily. The closing costs are more significant, are higher. It's almost like 5.5% in closing costs. And then you get the first 2 years, maybe 3 years, depending, maybe because there's a 3-2-1, works the same way. That in a way basically is how essentially they're trying to market the 50 year is where the payment's cheaper up front and then you just refinance when market rate is better, which is, can be an undetermined amount of time. I'd say and when I read like the purpose for the 2-1 buy down or just the temporary buy down program, the purpose of it was for people who were starting off with low income. and are expected to improve their income. For example, like, I don't know, like a doctor. Like they
Right.
start off really low income relatively, and then they over time, just like anybody at a job, they start off low and then they're expected to improve.
Yeah.
That's what the 2-1 buy down's meant to be, or meant to be for as well, what it was designed for. And I think the 50-year mortgage is the same way. Um, but in this case, I would almost advise going into the temporary buy down program more than a 50-year mortgage, just because, like, I don't know, just the yes, it's gonna save you $350 a month, but in the long term, it's gonna lose you 3.5 times more in how much you pay down your mortgage. It almost doesn't make
Right.
sense. So, oh yeah,
Yeah,
I
for
should have
sure.
showed this. Here I did a little worksheet. So this one is kind of goes into more detail. It gives you a graph on the 50-year mortgage in this case. So we talked about depreciation gain after, let's say it's 4% annual appreciation after 7 years. Um, you gain about 142,000, which is the same for a 30-year mortgage, right? Because it's all about the asset. But what is determined by a loan is how much you pay down the mortgage, right? So in this case, you see it's almost like 14,500 basically. Um, and you notice that this black line is how much you paid on the balance of the loan, right? So if you see this, it doesn't change very much over 7 years, right? If you notice that. So if I put it side by side with a 30-year mortgage, you can see that this black line is more significant.
Yeah.
It's a little more steeper than it is flat. So if you kind of see those two lines and how they're one's more steeper than the other, that gives you an idea of like, okay, yes, I could save $350 a month, but what's the purpose of home ownership if you really think about it, right? At the end of the day, when it comes to numbers, what's the purpose of home ownership? It's to build an asset.
Yeah.
And it's to build equity, right? It's to build something that you are gonna own and you can make money on, all that stuff. So it almost looks like, from that perspective, if you're looking at it just from the charts perspective, you're not going to really have much. Let's say it doesn't appreciate at all after 7 years, right? You can just look at these two numbers. Oh, that's I don't know, it's a $35,000 difference.
Yeah.
You know what I'm saying? So like if your closing cost for a seller is like 7%, um, that's going to be a difference between a short sale or not. You know what I'm saying?
Right.
So that's the hard truth I'd say between a 50-year and a 30-year mortgage is that this is not wealth building after 7 years. And
Yeah.
most people aren't going to be in their house for more than 7 years, typically. Even if they say they are. I've seen people say, "Oh, we're going to be in the house for 5 years," and sell their house the next year. It happens all the time.
Yeah.
So things change, life changes. So if you're going to I'd say if I was going to put my client in the best position possible is if they can't, yeah, if they can't afford an extra $350 a month, I mean, maybe they should be buying a house in the first place.
Yeah.
You know what I'm saying? So sure, it might make it a little bit easier on the finances, but like, why are you shopping at that high anyway?
Yeah.
You know?
Interesting.
Yeah. So
And
that
it's
gives you
I
an idea. I
guess
mean, the appreciation is the same after seven
yeah.
years. I mean, yeah, that's the main thing is this amortization gain. That's the big number. So, um, for me, that's yeah, I'd say if you look at it from this perspective, I mean, you can see that the steepness between these two lines are almost the same compared to, and where this one's more flat and this one's more steep. And that's the point of like appreciation is that as the years go by, this gap gets bigger and bigger because this is coming down and this is going up, hopefully about the same rate, but they're not in this case over here. This one you're banking on appreciation, which I guess now that I think about it, would make sense in like the West Coast markets because appreciation is so high typically
Yeah.
because it's so desirable to live here. So maybe in your West Coast markets, but in other markets, our appreciation's not even that high. Like you're in the Midwest and the South and like the northern states where most people don't really want to go to. Um, I would not recommend a 50-year mortgage. Home prices aren't even that expensive in those states either. So like, I don't know. I'd say suck it up, but can't really say that. What else you got? Alexis, got any thoughts?
My mind is blown with these numbers. It's kind of as expected from like before diving into it, I kind of expected very high interest and then lower payments, but like actually seeing it visually,
Yeah,
it's so hard to figure out what kind of a client would be the best fit for this.
it'd be a
Even
very
in,
marginal client. Like,
yeah,
you
like
know what I'm saying? Like it would
maybe
be a
someone who
client
wanted
that's
to
struggling.
rent or, well, yeah,
And like
but just,
why and
yeah,
I've been we kind of gotten some more on the train of like telling clients straight up like maybe it's not the best time for you to buy a house. You know, like it's
yeah.
maybe because it like home ownership is not it doesn't solve any problems. If
Hmm.
you really think about it. If anything, it creates more problems. If and in the sense of like more responsibility. So
Yeah,
like it costs money to own a house, it costs money to maintain a home, like all that stuff's on you. The money's made at the end when you sell the house. Like it's not going
yeah.
to solve. Sure, you don't have to move every year, which I'm sure say can save you a couple $1,000s a year. So that's one thing. Um, your rent doesn't go up as much as property taxes does, typically. Sometimes they do. But
Mhm.
generally, your rent going up compared to what your mortgage is going to go up is not the same. Usually it's home that's about it when in regards to like advantages of renting and advantages of homeownership on a day to day. Of course, you can sell the asset at the end after some time, but like on the day to day of owning a house, it's gonna be there's more responsibilities. Like my client that tried to buy a house, and the agent's like, these are people who should never buy a house because they don't know how to maintain a house. They barely knew how to maintain their rental.
Right.
So now, as you guys know, like the more you neglect a house, the more it's gonna cost to uh maintain the house or get it back
Yeah.
to maintaining standards. So like.
Or the less you'll be able to sell it for in the end.
Correct, correct, exactly. So it's all going to impact you. So there's all this levels of responsibility that you have as a homeowner. So
Hmm. We
it's,
just need a lot more education, I think, coming out. So I think it's extremely important that you're doing this to inform, at least us and like get it out there because I could see potentially our younger generation, you know, thinking this is a great idea. Like, oh, yay, I can afford a house now. It's going to be more affordable. But then if somebody doesn't explain it fully to them, or I don't know,
yeah,
we're
I
not
mean
in
it's
the
the half-life marker when I did this whole thing, I did this last week, just built a presentation and stuff like that and did the research and I was like this half-life marker and then this when I built out this chart, it blew my freaking mind as far as like
yeah.
because I didn't think it was gonna be that big of a discrepancy. I was like, maybe
Hmm.
it's half as much. You know what I'm saying? Because it's from 15 to 30 years, it's about the same. Like it's about half as much or half as more,
Yeah.
or 50% more, whatever it was. So it kind of scaled, but from 30 to 20 year, it doesn't 30 to 50 year, it doesn't scale at all. Like it's
Yeah.
totally different.
I think
Like
less
it,
than 1% of people that utilize this loan is going to keep it more than 30 years, even,
right.
Like, yeah, that's
Yeah,
crazy.
yeah. I've met a few people that have been in the same house for 20 years. Maybe that I count on my hand, maybe four or
Yeah.
five that I've met over the time, like which is great. I'm sure they're like, oh yeah, my house is worth all this much, and I don't have to make I paid this little. I'm like, that's amazing. I think that's awesome.
Hmm.
However, like, they're not gonna have that experience. I mean, I don't, yeah, it's very little. So yeah, Brendan, I know you're relatively new, so like that's another thing
Yeah,
consideration that when you were sitting down with your clients, whether selling or buying, is that the amount of people I've seen stay in a house for more than 10 years is extremely small.
interesting.
It's
Same.
very
Yeah.
small.
Well, if you think about it, you get a 50-year mortgage, you pay it off to the very end, and you buy at 20, you're 70.
Yeah, I mean, yeah, you're at 20, yeah, you're at 70 years old. I mean, yes, you could put extra payments,
Hmm.
all that stuff, but if you can afford extra payments, you can just go to a 30 year
Yeah.
and it would just obviously it would be 3.5 times more. And also you have extra payments, which also kind of makes that exponentially better. So It's just yeah, it's really fascinating to kind of when I work these numbers, I'm like, this story does not make sense at all.
Hmm. Are there any changes to like the overlays or stipulations? Is it pretty much the same?
I don't know about that yet, I'll be honest.
Okay.
This whole stuff is relatively still new. I mean, they just
Yeah.
announced it a few months ago. So, I don't know if I would imagine so
Yeah. So
because I don't
can
know,
I
like
get a 50-year mortgage like as of today? It's a product.
I don't think so yet. I think they're working
Okay.
on it. Um, yeah, this takes a while to kind of figure out because the other piece of what they have to decide is um, who buys it. You know what I'm saying? Like who buys this as the investment to hold on to, just like a bond. Like they have 30-year bonds and stuff like that, but who's going to pay for a 50-year mortgage? And this assumes that 50-year mortgage rates are going to be the same as 30-year. Does that make sense?
Yeah.
Yeah.
So, so they have to make it attractive enough, which I mean, there is some level of attraction there because the interest is much higher, almost double. So there is that piece, but yeah, I don't know. Like that's the product itself would make sense to investors because they're making a lot of money on the interest, but they have to get people to buy the 50-year mortgage, like get into a 50-year mortgage to make it a product for investors to want to buy. And it has to be enough. So that's the other piece. It's just like a business. Like how do you okay, you create this amount awesome product. How do you get to market to people who buy the product? And then how do you have enough sales so that investors are willing to help you out and loan you money and stuff like that? It's the same discussion. Does that make sense?
Mm.
Yeah, totally. It'll be
So,
interesting to see what happens with this.
but I would imagine there would be, I don't know, because technically, I mean, the qualifications are relatively the same between a 15 and a 30-year mortgage. The only difference things that changes is the payment. But going from like 30 to 50 years, I mean, I don't know. I would imagine there are some tighter requirements because it's over 50 years instead. Um, as far as like income requirements and assets and stuff like that. Yeah, I just don't see the value in it other than trying to get more other than a marketing employee try to get more buyers in the market. But the problem is that it's not that we don't have enough buyers. That's not the issue. Our issue is that we don't have enough inventory. So we need to
Yeah.
create more inventory. And maybe this does help create more inventory by having these sellers come out of the woodworks and maybe consider this. But like when you break down the numbers, it really doesn't make sense.
It makes sense if you're a bank.
For sure. For sure.
Yeah.
Yeah,
But not
for
for the
sure.
consumers. No.
Correct. Yeah, yeah.
Building your
So
wealth.
I'd say yeah, I guess Brandon, to answer your question, it had to be a situation where a client would be marginal and need the extra few $100s of savings just to be able to afford a house.
Yeah.
And then once they are, and with the expectation of being more financially stable in the next couple of years, and once they're more financially, I guess, more capable, they can refinance it to a 30 year.
Right.
I can see that making sense. Um,
Yeah.
Yeah, but if a client's already having a tough time going between a 30 and 50-year mortgage, I would also question whether they should even buy a house in the first place.
Yeah.
So,
All this is just crazy. It's
so
interesting.
yeah.
And how long do you think it'll be for it to, fully roll out?
I don't know. I haven't seen any messages about the 50-year mortgage as a new product on our end. I have to do some more
Mhm.
research as it comes out. Because I mean, have you guys heard from any of your other lender partners about the 50-year mortgage?
Mm-mm.
Okay, so yeah, until yeah, they will tell you. Trust me,
Yeah.
they will reach out to you and they will tell you. It's just it will be another point of conversation for them to reach out to you about.
Right.
So, but yeah, they just said that the president approved it, and now Fannie and Freddie may have to figure out how to make it a product that's usable. So basically how to describe it. Imagine, imagine the president said, okay, you can, business from marijuana is now federally legal, right? And now the states have to figure out how to like make the
Yeah.
weed, the marijuana business a legal entity and all that other stuff, right? So that's kind
Right.
of where it's at. Even though there's a obviously the state kind of just said fuck it and just like made their own business anyway. But let's imagine like we didn't have the marijuana business already in the state, and the federal government say, yeah, it's cool. You can open a marijuana business recreationally. Now it's on the states to kind of figure out how to make that happen, find the business owners. So kind of think of that path on what has to happen in order for it to be um for you to be able to purchase it at that point.